Navigating the municipal bond seas, assessing financial stability and default risks. Introduction. In the expansive universe of fixed-income investments, municipal bonds emerge as a cornerstone for investors seeking income with a modicum of risk. However, the allure of municipal bonds comes with the imperative for investors to conduct a thorough assessment of the financial stability and potential risk of default associated with these instruments. Unraveling the complexities of municipal bonds requires a keen understanding of the factors influencing their financial health and the tools investors can wield to gauge the risk of default. Municipal Bonds 101. Municipal bonds, commonly known as munis, are debt securities issued by state and local governments, as well as various governmental entities such as school districts and public utilities. These bonds serve as a means for these entities to raise capital for infrastructure projects, public services, and other initiatives. Investors are drawn to municipal bonds due to their potential tax advantages, relative stability, and the perception of a lower risk compared to corporate bonds. Credit ratings as a North Star. One of the primary indicators investors rely on to assess the financial stability of municipal bonds is their credit rating. Assigned by credit rating agencies such as Moody's, Standard & Poor's, and Fitch, these ratings provide a snapshot of the issuer's creditworthiness and the likelihood of default. Municipal bonds with higher credit ratings are deemed less risky, while lower-rated bonds may offer higher yields but come with an elevated risk of default. For instance, a municipal bond with a AAA rating indicates the highest level of creditworthiness, suggesting a minimal risk of default. In contrast, a bond with a lower rating, such as BB or below, signals a higher risk profile, prompting investors to scrutinize the underlying financial health of the issuing entity more closely. Analyzing financial statements and budgets. To delve into the financial stability of municipal bonds, investors must conduct a thorough examination of the issuer's financial statements and budgets. Unlike corporate bonds, which are backed by the revenue and assets of a business entity, municipal bonds rely on the financial health of the issuing government or agency. Investors should analyze key financial metrics such as debt levels, revenue streams, and operating budgets. A growing debt burden relative to the issuer's ability to generate revenue may raise concerns about the sustainability of debt service obligations. Scrutinizing budgetary allocations for essential services, debt repayment, and contingency plans can offer insights into the issuer's commitment to fiscal responsibility. Economic and demographic trends. Beyond financial statements, investors must consider broader economic and demographic trends that could impact the financial stability of municipal bonds. Economic downturns, population shifts, and changes in property values can influence the revenue streams available to municipalities. For example, a city heavily dependent on property taxes may face challenges if property values decline or if a significant portion of its tax base relocates. Analyzing demographic trends is equally crucial. Municipalities experiencing population growth may have a more robust economic base and increased revenue potential, while those facing population decline may encounter challenges in sustaining essential services and meeting debt obligations. Default and recovery history. Examining the historical default and recovery rates of municipal bonds within a specific region or sector can provide valuable insights into potential risks. If an issuer has a track record of meeting its financial obligations, it instills confidence in investors. Conversely, a history of defaults or distressed financial conditions may raise red flags and prompt a more cautious approach. Consider a scenario where an investor is evaluating municipal bonds issued by a school district. If the district has consistently met its debt obligations and demonstrated prudent financial management, it may be perceived as a safer investment compared to a district with a history of financial distress and missed payments. Legal protections and structural features. The legal protections and structural features embedded in municipal bonds play a pivotal role in determining the risk of default. General obligation bonds, GO bonds, are backed by the full faith and credit of the issuing municipality, providing a higher level of security. Revenue bonds, on the other hand, rely on specific revenue streams, such as tolls or utility fees, to service the debt. Investors should carefully review the legal framework governing the bonds and assess the priority of bondholders in the event of financial distress. Understanding the covenants and security provisions can offer clarity on the level of protection afforded to bondholders. Insurance and credit enhancements. To mitigate default risk, some municipal bonds come with insurance or credit enhancements. Bond insurance guarantees the repayment of principal and interest in the event of default, providing an additional layer of security for investors. Credit enhancements, such as letters of credit or bank guarantees, can also bolster the creditworthiness of municipal bonds. However, investors should exercise caution and conduct due diligence on the insurance provider or entity providing the credit enhancement. The strength and creditworthiness of these third-party entities are integral to the effectiveness of these risk mitigation tools. Conclusion. Investing in municipal bonds requires a judicious blend of financial acumen, due diligence, and an understanding of the unique factors shaping the financial stability and default risks associated with these instruments. As investors navigate the municipal bond seas, they must leverage tools such as credit ratings, financial statement analysis, and an awareness of economic and demographic trends to make informed decisions. By peering beneath the surface of credit ratings and embracing a comprehensive approach to risk assessment, investors can chart a course that aligns with their financial goals while navigating the intricate waters of municipal bond investments.